Hello, greetings, and welcome to Dividend Blasters. This is our 79th video, and our topic today is grow your cash flow. Over the last 4 weeks, I've collected $10,450 in premiums, selling covered calls. I'm going to share with you my journey, what I did, how I did it, and we'll go from there. All right. First, a disclaimer: I'm not your financial advisor. Purpose of this video is for information, education, reflects my own personal opinions, research, experience as an independent investor for more than 30 years. So please do your own research and consult a financial advisor and do your due diligence. But do this before you make any financial investment decisions. Let's cut to the chase. A quick summary over the last 4 weeks. And if you see my previous three videos, I've shown you what I've done week by week. This is just a quick summary. As I mentioned, over the last 4 weeks, I've collected $10,450.49 in premiums. After fees, it's $10,381.72. You can see what the activity is week by week. It's come down a little bit the last week because the previous week I had a handful of assignments that I did not want. So I decided to set some strike prices a little further out of the money, take the lower premium, and avoid assignment where I could. That did pan out this past week. I had almost no assignments, a couple of them. Also, I have calculated that for the past month, my yield um, against my investments, 3.17% for the month. That's a monthly yield. I like that. I think that's really good. If I can replicate this or get close to it and getting that 35% yield for the year, I'd be very happy. That to me is an additional dividend. So this does not include dividends. It does not include price appreciation. This is another return that I'm adding. And I'm taking all of these yields, which are cash premiums that I'm collecting, and I'm reinvesting them back in the portfolio, building the holdings, growing my snowball. So when I get dividends, I'm going to have higher holdings and more dividends. All right, let's get to it. So first one I did, and these are almost all of them are weekly. I sold a covered call on Amazon. You can see from the graph that I set that strike price, and it's the blue dotted line at 197.50. You can see where I got in the orange line, and it's the price performance for the past week. I got in a little under 193, and it expired well below that strike price at a little under 190 seven. And I collected $81.34 in net premiums. So to me, that is successful. I have these holdings. I can go ahead and do another weekly covered call next week. And I like weekly because I like to have that compressed contract performance. I can watch it. I get my premiums and I can watch it. And if I want to take additional action within that week, I can act quickly and I'm focused on it like a laser beam. That's just my approach. That could change, but right now, that's my approach. Next one, Broadcom. You can see how I set that strike price at $200, well above my entry price in selling the cover call and well above where it expired. I collected $98.44 in net premiums. This expired worthless, and those holdings are retained. I can go ahead and do this again next week. Next one, Chevron. Well, here, this one was a little bit different. I set that strike price at 162.50. I sold the option well below that strike price line. You can see it. And this was a sign because the performance just blew right past it. Now, I did collect $43.34 in net premiums, but this option was assigned. These shares were sold for $16,250. That was a profit for me. So what am I going to do? Okay, well, I don't own the shares now, but I do have the cash. So I can do a couple of things. I can go back and just buy them. I'm going to watch and see what happens Monday. And if I see a price dip, I'll buy them. Or I may do a cash secured put. And take another premium and set a strike price below where I'm getting a profit. Either way, I'm going to make money. I don't lose any sleep over an assignment. To me, I just take the cash and I move on. And I take that cash and I'm going to reinvest it in the portfolio. Next one, energy transfer. Well, basically, I collected $10.87 in net premiums. This option expired worthless. I have retained the holdings, which are 200 shares. I will go ahead and sell another covered call on Monday. Next one, Google. Google. Well, this one was assigned. And here you can see I set that strike price 162.50 and I sold that covered call well below that. And I collected $86.34 in net premiums. But the price performance, it just blew past it. So these holdings were sold for $16,250. So I'm sitting on some cash here with Google and with Chevron. I'm going to do the same thing. I'm going to see what happens Monday. I'm going to watch the price. I may go right back in, or I may sell a cash secured put, buy them at a discount to get back in, or I just may go ahead and redeploy the cash somewhere else in the portfolio. Either way, I move on and I have the cash. Next one, Coca-Cola. So Coca-Cola, this was a very low premium because there's very little volatility here. And one thing that I'll mention is you'll see the Greeks in the far right of the table, shaded in pink, purplish pink, lavender. The lower that delta is, the less likely there's going to be an assignment. My rule of thumb, and I've studied and I've talked to other people, is if I do not want an assignment and I want to retain the holdings, I'm looking for a delta of zero point 0.3 or less. If you get a little bit of close to zero point 0.3 or above it, there is an increased likelihood of an assignment. So, very low chance of an assignment because the delta is very low, and of course, a very low premium. Some of these I may not, sell a covered call because it may not even just be worth it if the premium is too low. But I'm getting my sea legs here, and I'm having a good time. So anyway, $5.44 net premiums, holdings retained. All right. Well, this one is exciting, and I have several hundred shares of Nvidia, and I put 400 of them up to back two covered call options. And I set the strikes at 122 and 124. And you can basically see that I collected $356.44 this past week in premiums just from NVIDIA alone. Um, the four options expired well below the strike prices. Really, you're looking at around, I think, $117.70 or both of them. I did them simultaneously. Why am I showing two entries? I have these across two different accounts, so I'm tracking them separately. So that's why. But you can see where the delta is, and they're both in the low point twos. So, you know what? Could I have gotten a higher premium? Yeah, I could have. If I'd sold a little closer into the money, and of course, I'd be encountering a greater risk, taking on greater risk of assignment. I didn't want to do that because I'm really looking at Nvidia as something that I want to hold for the long term. I just feel that this is really going to be the future. Most of us do of artificial intelligence, and you really have to be part of it. Okay, next one, Pfizer. Well, this one here, I collected only $6.87. Low delta. I got in well below, selling the cover call well below that strike price, and it stayed well below. It's fairly steady, stable, not volatile. Next one, SoFi. Well, this one was assigned. This one was a little bit surprising. The delta is below zero point 0.3, but it's up in the high point twos. I did set that strike price well above that price where I sold the covered call. I set it at 12.50, and of course, it just blew past it. It finished the week at 12.87. These were sold. Now, I did collect a little under $25 in net premiums, but the holdings were sold for $2,500. So, what am I going to do? Same thing that I'm going to do with Chevron and Google. I'm going to watch, see what happens. I have the cash. I can go ahead and Buy back in if I see a massive dip. I can sell a cash secured put, buy back in at a planned discounted price, or I can just go ahead and redeploy the cash somewhere else. All right, next one. Taiwan Semiconductor. Taiwan Semiconductor. Well, I set this bad boy at 177.50. I've been doing this for a few weeks now with Taiwan Semiconductor. It came close, then it kind of went down a little bit. You can tell by the performance line. Um, but where I got in well below that strike price, and it finished below. It did get close on Thursday, but I collected $119.34 in net premiums. The option expired worthless. Those holdings are retained. Next one, UPS. UPS. Again, I have UPS across two different accounts, and I sold covered calls on both of these holdings across these two accounts. I set that strike price at 122 for both sets of them. And the covered calls was sold well below that. And I collected $53.78 for the week for both of these covered call options for UPS. And you can see the price performance actually went down a little bit. I would like for the price to go up, but to stay below the price line, the strike line. So that's the ideal for people that sell covered calls. I have the premiums and I have the holdings. So we go again on Monday. Next one is Visa. Oh, I like my Visa. This is one I don't want to part with because this is a really steady performer. So it did get a little bit close. I did set that strike at $340, and I got in at I want to say 334.25, well below, just based on stock performance. This is not a highly volatile stock. It just kind of moves slowly, but continually, slightly bullish. You can see that around Wednesday and Thursday, it was getting very close to that strike price line. But then towards the end of the week, it just went down. So I did collect $94.34 in net premiums. The option expired worthless. Holdings are retained. Okay, now here is an ETF. VOO, it's the S&P 500 ETF from Vanguard. I sold two covered call options, and I set that strike price at 525. I sold it when it was trading at around 515.99. To me, that was fairly safe, and it's this the performance stayed well below that strike price line, and I collected $284.66. I'm sorry, $294.66. The holdings are retained, and we will do it again on Monday. Next one is Verizon. So some of these stocks I hold because they're good stocks. I like them, but I've bought them because I find them to be fairly economical and cheap and easy to sell covered calls against. And Verizon, like Pfizer, is one of them. SoFi was another one, but there are others as well. But Verizon, uh, you can basically see that I collected about $12.44 in net premiums. Now, would I like that to be more? Yes. The way to do that is I got to put more shares behind this. So more than 100. I would have to increase this maybe 4 or 5 fold to make it worth it. So I'm thinking about that. And we'll see. But basically, that strike was set at 45. It never seriously contended. I sold those calls at around 44, 35. But this is a slow moving price. Price wise, it's slow moving. And it closed well below that. So the options expired worthless and the holdings are retained. Next one, Walmart. And again, I have these across two accounts. I sold two covered calls and well below the strike price line. And I set one strike at 91, the other at 92. Both of these were covered calls were entered at around the $85, $86 price. And you can just see the performance. Walmart is a fairly gentle performing stock price wise, and it closed around 86 bucks. Anyway, I collected $37.78 in net premiums. Options expired worthless. Holdings retained. Okay, now here's just next two slides. I'm just going to talk about some options that I sold over the last few weeks, and I already counted these premiums in the previous few weeks because that's when I sold them. But I'm just sharing these with you because these expired yesterday, worthless. So I still have my SCHD and SCHG. These are Schwab ETFs. One is the U.S. Dividend ETF, Dividend Growth ETF, and I have 12 option contracts, and I have SCHG, which is the large cap ETF, and I have 12 um, options contracts for that as well. Uh, I set these well below the strike price lines, but you look at the performance lines; they look kind of close, but these do not fluctuate significantly. You're going to see less fluctuation in a lot of the ETFs, and these two are no exception. So these are both fairly safe from assignment, and you can see that they both expired worthless. I collected $433.46. Now, again, these were not 1 week options. These were like 3 and 4 weeks. So they take a little more time, and I have bigger holdings here. You're basically talking about 24 options contracts between the two. So the premiums are going to be higher, and the return is going to be higher, but you're going to have a longer period of performance. So anyway, those holdings are retained. Next one, and the last one. QQQM. This is the Invesco Nasdaq 100 ETF. Um, this one was again about almost 3 weeks, and I set that strike price well above the performance. I set it at 215. You can see that this thing expired worthless. I collected a couple weeks ago over $1,100 in net premiums, and yesterday the option contract ended and expired worthless, and I've retained my holdings. So, what will I do Monday? I will probably sell six more. And it was six contracts, six more covered call option contracts on QQQM. I will probably also do the same with the Schwab, 12 for SCHD and 12 for SCHG, and that'll be more of a monthly thing. And here is just kind of a summary. Over the last week, and actually this is a typo. It's $1,326 in options premiums uh, the last week, and I have that in the result bullet in the bottom below the table. I did sell 24 covered calls. 20 of them expired worthless, and those holdings were retained. So to me, that is a good outcome. 4 were assigned. I'm not losing sleep over it. I prefer that none of them be assigned. Um, but I have the premiums. I also have the proceeds from the sales of about $35,000, all sold at a profit. So I have some options here uh, to pursue, and I'm taking a look at that. And Monday, we'll see. Now, as I said at the beginning, the monthly yield for all of these uh, options that I've collected equates to about 3.17% just for 1 month. To me, that's like another type of dividend, and I'm very pleased with that. I would like to replicate that on a monthly basis. So that's probably the plan. I'm going to continue to refine my approach and my methodology, and we'll just go from there. So, folks, that's it. I hope you found this to be educational, informational, entertaining, useful. Um, and if you liked it, please give us a like and share this with a friend, and hit that notification bell. So the next video that comes out, you will know when we have new content to share. All right. Also, as you may know, I am a affiliate partner of Seeking Alpha. This is a wonderful resource. If you're interested in subscribing, you can select the links and get a 7-day free trial as well as a discount. Read the directions that come with a link. I think it's a great resource, and the price is right. All right. And if you want to follow me on X or on Instagram or Facebook, I'm there. Look for the blue check as well as my logo, Dividend Blasters. I also have colleagues that are on X and Facebook. Check out Dividend Snowball. Also, check out a colleague of mine, Dividend Stockpile on YouTube. Just really great content on dividends. And folks, that's it. Have a wonderful, wonderful day. Until our next video, God bless.